Let's get in Subir Gokarn, former RBI Deputy Governor, who joins us right now on the show from New Delhi to talk about, of course, the CAD, the figures come out today, but lots more behind that as well. Good having you, Mr. Gokarn. Thanks so much for joining in. The current account deficit seems to be the biggest concern right now, and we depend for the foreign funds to finance the CAD. How concerned are you about the high CAD?
Well, the current account deficit obviously has to be financed by foreign inflows. Now, they can be financed by market-determined inflows, market-based inflows, portfolio investment, direct investment in whatever form, or they can be financed by aid. We've moved out of that aid category many years ago because market flows were more than adequate to finance whatever current account deficit is running. But as the current account deficit increases, particularly in an environment where global uncertainty is still very high, the risks increase. The risks of not being able to finance it through steady capital inflows increase. And I think that's really where the concern is emerging. Now, of course, the number is unprecedented. There has been a general perception that India can sustain a current account deficit of 2.5% or perhaps up to 3% without too much stress in terms of financing under a reasonable set of global circumstances. Now we're looking at the number edging up to over 5% and with global capital flows becoming less certain. So that combination is really where the worry is. How it has reached 5% is really the question. It has emerged from a number of sources. It's not just one factor. There is the oil bill, there is the gold import bill, and there are other things happening on the minerals front in particular with the reduced export of iron ore and the increased import of coal, which are all contributing. So it's not just one cause to the problem. There are multiple causes and these require multiple responses.
Mr. Gokarn, hi, morning. Ad hoc measures like increasing gold duty have been undertaken already. It may pay off, but perhaps only marginally so. What can really be done to reduce the deficit, and do you believe that our first priority should be to finance it?
No, I think when you talk of financing it, it essentially means creating more predictable, more reliable channels of capital inflows. Now, that's difficult to do in the short term. It's particularly difficult to do when global conditions are what they are. There is, of course, liquidity. There's a lot of liquidity which is driving capital flows into emerging economies. But these are short-term in nature. These are flows that can reverse very quickly if circumstances warrant. So this is not a very predictable or reliable source. So when you talk about reducing the current account deficit, I think we have to address all of these. We have to think in terms of reducing the oil import bill by basically by pricing petroleum products domestically, which encourages conservation. Gold, I think, is an important issue, and the Reserve Bank came out a few months ago with a set of recommendations relating to development of financial products that can substitute for gold. On one hand, these are things like inflation index bonds, but there are also other gold-specific products, what I would like to call dematerialized gold products or demat gold products, which give you the investment attributes of gold, but without the need to physically possess it. That's I think a set of alternatives where the physical import of gold may be reduced, even though people want to invest in it. And on the minerals front, I think we've got to address the issues of environmental compliance and so on, which are impacting iron ore production, and also with respect to increasing coal capacity, coal production or coal extraction capacity, which is otherwise leading to very large imports of coal. So a number of different things have to be done, and I think each contributor to the current account problem needs to be addressed specifically and directly.
India's perhaps staring at a decade-low growth for FY13, given the 5% levels. Do you believe that a 6.5% is realistically possible in FY14?
I think it depends on what is done to facilitate it. So to some extent, I think it's a little naive to expect it to happen in a business as usual scenario with nothing being done. There are a number of policy challenges that are obviously being debated in the public domain. Getting public investment up is one, which means essentially rebalancing government finances. That's not going to happen overnight, but there needs to be some long-term commitment to this, reducing the consumption part of government spending and focusing more on the investment part, that is creating assets. I think that is a very, very important precondition for accelerating growth. Bringing inflation down, creating conditions where interest rates can actually move from being focused on containing inflation to supporting growth. But to do that, we need to get food prices and food inflation down very quickly. That is really the stumbling block on the growth inflation balance, and I think that is something which the government needs to put very, very high priority on.
Right. So if you talk about growth, the high levels of 8.5% to 9% is what we saw when the economy was on a stimulus. Do you believe that new normal for growth is now going to be 6 to 6.5%, and we should come to terms with the fact sooner than later?
No, I think all of these are conditional statements. We grew at 8.5 or 9 because of certain underlying circumstances. The global economy was one factor. Keep in mind that the global economy is growing during that 5-year period at over 4%. It's now below 3%. So there is an impact on all countries' growth from an overall slowdown in the global economy. Then there was a massive change in our investment pattern. We moved from 26-27% of GDP before that high growth phase started to 38% at its peak. And what that meant was we were putting more and more resources into creating capacity, both in the public sector and the private sector, to facilitate more output, which contribute to faster growth. We are down to about 31, 32 now, and within the public sphere, the consumption, the expenditure pattern has shifted very dramatically towards consumption by virtue of the subsidy bill. So there are, I think, very easily identifiable indicators of what are the macroeconomic conditions that support high growth. And policy has to focus on getting these indicators back to those levels. So if that process begins, I think we'll start to see growth accelerating. But if that process does not happen, does not take place, then I think we have to be reconciled to a somewhat slow growth outcome. We can't do anything with the global economy. That's going to take its own course, whatever it is, and that's going to take away from growth under any circumstances. But domestic triggers and domestic drivers of growth, I think, are known. We've had the experience. We know what worked in that high growth period, and we've got to get things back to that situation.
Mr. Gokarn, the other important bit has been inflation, wherein the levels are still reasonably high. At least I would want to believe that the CPI levels are very high. But just talk about WPI and the 6%. Is that the new normal for inflation? And should policy making happen around that figure?
Again, I think, I'm very uncomfortable with the phrase new normal, because it suggests that we basically have no control over the process, that we should just accept a reality over which we cannot exercise influence. And I don't think that's the situation with food. There are many things that we can do domestically that can increase the productivity of our agricultural sector very quickly, reorient cultivation to grow things that people are eating more and more of but aren't being produced in adequate quantities. So these are control variables. These are not characteristics of a new normal. And to the extent that we are not doing these things in agriculture, we are risking the perpetuation, the entrenchment of food inflation at above 10% month on month, year on year. Well, year on year, every month. It's already been in place for 4 years and more, which actually hugely limits the space that monetary policy has to address growth concerns. So the fact that core inflation has come down reflects the slower growth. But even as core comes down with headline remaining at above 6.5, that suggests the power, the influence that food is having on the overall inflationary process.
After the union budget and the slew of reforms that that the government has undertaken, a lot of attention has now shifted to what can the monetary policy do. There is a lot of debate on the need for lower interest rates as well. How difficult do you think is it for the monetary policy to manage growth as well as balance out inflation?
I think it comes down to what the persistent structural drivers of inflation are. to the extent that these are exerting a heavy influence on the inflation process, it makes life that much more difficult for monetary policy. Because typically you expect that slow growth will very quickly translate into lower inflation, which it has if you look at core. But because of the persistence of food inflation, non-core inflation, supply side inflation, whatever you want to call it, that is having a sort of it's having a drag effect on the otherwise visible adjustment process, and because that keeps inflation from going down very quickly and by very much, it limits the space that monetary policy has to focus attention or put its priority on growth.
Lastly, Mr. Gokarn, how convinced are you about the government's fiscal consolidation roadmap? I mean, do you think a 4.8% deficit for the next year is a realistic target? Given that it is going to be election year, there could be more fiscal slippages instead of actually going on to the roadmap of fiscal consolidation.
I think there's general recognition that in the absence of very committed efforts to keep the deficit under control, to bring it down as we go forward, that there are several risks that might emanate, including the rating downgrade risk, which is now in some sort of abatement but flared up a few months ago. That's a very tangible risk, and it can do serious damage, particularly in the external front. And we were talking about the current account deficit and financing it. A rating downgrade will actually have a very significant impact on that situation. So I think there's commitment. I think there's a sense of a keen sense of the opportunity cost of not carrying on with fiscal consolidation, despite the fact that it's a pre-election budget. So to that extent, I have some comfort. Where it may slip are some of the assumptions that have gone into the consolidation process. But it's reassuring to see, for example, that even though it's a slow process of adjustment on diesel prices, that it has been persisted with. And to the extent that people start to expect it and build it into their calculations, I think that will in itself have an impact on the credibility of the consolidation process. And likewise, I think it's very important for the government to keep following up on the commitments that it has made in the budget to reinforce the credibility of the fiscal consolidation program.
Mr. Gokarn, really appreciate you taking the time out and chatting with us today on ET Now.